Let's talk about fintech disruptions. Take a little bit of a longer term view. So right now, the current state of global fintech is that there are almost 1,400 companies with $26 billion in funding and about $44 million average each. There's three reasons for this rise in fintech, right? It's democratization, disintermediation, and experience, right? And these are likely to continue to fuel these changes. And I could tell you that it's really hitting a number of industries, right? So if we're thinking about fintech, you might think, well, gee, this is a little bit different. But I tell you that this kind of disintermediation is really affecting the financial sector and will continue. Now, the top reasons consumers adopt fintech products is because it's easier, right? It's easy to set up an account. The rates are lower. They have access to different products. Again, that democratization and a lower cost situation, right? Disintermediation. Also, better experience, better functionality, better quality, right? All these kinds of things. But that's going to continue, right? There are different things, and I'll talk about them in a minute. But if we think about different things you had access to now that are cheaper, that are different, and I'll talk about the big three trends in a second here, whether we're looking at crowdfunding or we're looking at cost-cutting things, whether that's transfers, international payments, whether that's the fees on managed accounts, anything like this. And then robo-advising. Those three areas are really driving the change. We see the deal flow, which is the orange here, which is on the left axis. It's been rising sharply. Since 2011, more than double the deals have been made in 2015 than 2011. And if you look at the funding of the deals, that's gone up much more sharply, right? So while there was about $2 billion in funding in 2011, in 2015, that was almost $14 billion, right? In 2015, it was $14 billion. In 2014, it was under 7. Right? So the expectations for 2016 were, you could see that number when the year shakes out, closer to $20 billion. So you're seeing a lot more action here on the funding side for global VC, but also that trend in these three hot areas, right? Crowdfunding, cost-cutting, and robo-advising. Those three trends are going to be really big, and they are really, really changing things. On the robo-advising side, which I'll talk about, there's also some overlap with cost-cutting. We'll talk about that in a second. First, on the crowdfunding side, we see opportunities here for job creation, economic potential, and also disruption, right? It's one of the three hottest trends, and this market is expected to grow from about $26 billion last year to $100 billion in 2020. And over 50% of Kickstarter and Indiegogo backers would like to, or even might prefer to buy crowdfunding shares rather than to simply back a project, right? So this is a really big deal because you have now a market that's not only growing, but you have people that want to be more vested in companies that are doing interesting things. They want to be part of a story. And they're looking for more interesting ways. And private equity, which is what this is being democratized, right? So now you have the legal ability, right, for people, if you have under $100,000 in annual income or net worth, you can still put in $2,000 or 5% of your annual income into private equity, right? Previously, you had to be an accredited investor, and that's very expensive with a really high threshold. Now, no matter who you are, right, you can put in at least $2,000, no matter who you are, right? That turns a market from really a handful of people, a million people plus or minus, into a market of 300 million people. So this is an example of democratization where there's growth and it fuels entrepreneurial opportunities. This is huge, right? Now there are some limitations on this. Even if you have over $100,000 in net worth and income, there's still a restriction that you can't put in more than $100,000. And companies for now are restricted and can only raise an aggregate of a million in terms of a fundraise during a 12-month period. Now that's going to go up soon to 5 million, but right now it's at 1 million. So what we see here is a growing area, lots of opportunity, lots of people wanting to get involved, and a lot more restrictions. So I'm sure like many of you, you've used Kickstarter, Indiegogo, and you might have had a bad experience, you might have had a good experience. I've had both good and bad, but a lot of times it's some random person putting up a project and you don't really know what you're getting. Something that the kids today might call a rando. And so randos have these projects, and maybe it's good, maybe it's not, right? But for crowdfunding, you have to file paperwork with the SEC, and there's due diligence involved, and there's an audit involved. And now you're talking about something real. You're not just sort of pre-ordering a product from some rando, you're now putting money into a company that's been vetted. Now, as far as cost-cutting projects, and different kinds of products that are out there. This is a foreign exchange board. I'm sure many of you have seen this. I've recently wrapped up a FinTech graduate certificate at MIT, and this is one of the areas I was digging in with on a team as we look at areas where there's ripe for disintermediation. Transfers, international payments, and fees. These things are real problems in terms of cost. But you can disintermediate them pretty easily. If you look at Venmo and you look at some different things with Bitcoin, there are ways to move currencies. There's a way to pay people now that are cheaper than before. And in terms of managing accounts, we've also seen on the Robo advising side, which I'm about to talk about, a reduction in asset management fees. So you see on the FinTech side, anything that's traditional or legacy or that had a big margin because something was complicated can now be made not so complicated. Can now be democratized, and you're seeing companies disrupt it. In the same way that you've seen Uber disrupt, sort of transportation and taxis, which had, pretty, monopolistic markets for a while. You're seeing traditional finance get blown out through the middle. And the impact is significant, and the awareness is everywhere. So I took this photo recently. So robo-advising obviously is a move away from actively managed money to passively managed money. So you're talking about ETFs, technical trading. Some of the graphs you've seen up that I've had have been technical graphs. And I know some of my friends here from the Market Technicians Association, they're chartered market technicians. And so some of these things are programmed and it's black box. And I'll talk about that in a second. But everyone knows that the jobs are going away. Everyone knows that this is going on. Now, where do you think this is? This is a poster. We believe mutual funds should be managed by humans, not robots. I took this picture in an airport. You see the robot in a suit and tie. Any guesses where this might be? The FinTech hub of the world. Anybody? Any guesses? Where? Abu Dhabi? Anybody else? San Francisco? These are good guesses. Jacksonville, Florida. Because when you think of FinTech, you think of Jacksonville, right? Now, guys, this is a real thing, right? If they're putting this ad up, everyone knows. To give you some idea of what the technical side looks like and why this is so important, there are hands in the market. About 2 years ago, I started doing research, not just fundamental, looking at oil and gas, supply, demand. I cover a number of markets. This is gold, but also looking at charts. And there's a couple lines that matter. And the first one is these bars that go up and down. It's called a candle chart. That's the price of gold. There's this blue diagonal line. You see that line there? And you'll notice it gets crossed here on the right. There's a little bar goes below it. And then there's a really big leg down. And it's been falling ever since. So here's the thing. 2 years ago, I sent an email out to my clients. And I told them I was going to be doing more technical analysis. Now, again, I started doing fundamentals, supply, demand, growth, the whole thing. I got an email back from a central bank that I advised. Not the ECB, but another one of the big 3 foreign ones. And one of the heads of trading emailed me, and I thought for sure he was going to call me out. I thought he was going to make fun of me for technical charts, or I was going to be poo-pooed, and I was worried about it. Instead, he says, thank you for doing this. This is so important now. There's so much trading that's going algorithmic, black box, that we need to watch the markets like this. Thank you. And that's kind of when I knew that I was definitely on the right path to be watching this. This was 2 years ago. At that point, over 50% of the trading shops were algo. It's more now. There's a lot more. And what I mean by this in algo and trading and technicals is that blue line that had been there for so long, for the whole year, closes below it resulted in a really big sell-off. And that was the line. I had that line on my chart all the way going back to January. You had a few points where it established a baseline. I was using that chart for that line for 9 months. And I told my clients the minute it goes below that line, it's going to be bad. And it was. This is how that stuff works. And what this is doing is, again, you can see the hand in the market. You can see you go right over the line and party's over, right? Trigger, 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 trigger. If you don't have people behind driving anymore, it's just robots, right? And as someone, I produce research. As the president of Prestige Economics, I write reports. You know who doesn't read reports? Those darn robots, right? But they certainly like charts and numbers and lines. Now, I'll give you another one. This is another one. Again, same post, different airport. This one's in Texas. FinTech Hub of Texas. Anybody guess what this one is? Where this might be? Any guesses? Come on. Dallas, Houston, Pflugerville. No, not Pflugerville, but anybody? Amarillo. Because FinTech and Amarillo, they're like this, right? This is everywhere, guys. This is everywhere. I have clients on the private equity side. They tell me that next year they expect commercial real estate in Manhattan will be down 30% because of this disintermediation. ETFs, passive investing, robo-advising, technical trading, revolutionizing what's going on the finance side. There's going to be a handful of people and just a bunch of computers at the end.